We're here now with Chance Finucane. He is the CIO of Oxbow Advisors, and he is here to discuss with us exactly what's going to happen this week with the Federal Reserve, how markets should react, and how you should allocate your portfolios accordingly for the medium and long term. Chance, welcome to the show.
Thanks for having me on, David.
Chance, we've had the founder of Oxbow Advisors, Ted Oakley, on several times. Great guest, one of our fan favorites on Kitco. So I'm excited to get you on now. You are the man behind the numbers. We were talking offline. So excited to get your take on the stock markets, your outlook on the Federal Reserve, the macroeconomic landscape, and gold. Let's talk about the Fed first. That is a big headline of the week. So meeting going on right now. They're expected by the markets to raise interest rates by 75 basis points. They're expected to release that decision tomorrow. What is your expectation, Chance?
That's our expectation as well. 75 basis point hike to be announced tomorrow. I think where everyone's focused is going to be the commentary of Jay Powell. And it seems as if investors and some parts of the mainstream media are really hoping for the pivot where you start to see the Fed become more dovish. But we actually think that Powell has been pretty consistent during the year, trying to focus solely on bringing down inflation. And whether that means he's setting up a 50 basis point hike in December or a 75 basis point hike, we would expect his commentary to continue to be focused on trying to bring down inflation and catch up short-term interest rates, especially up to that core PCE inflation number that is still slightly above 5%.
Okay. And long term, do you think they'll be able to tame inflation? As Federal Reserve Chair Jerome Powell has indicated that he wants inflation to go back to 2%. That is his target. How likely is that to happen in the foreseeable future, Chance?
It's interesting because they always are trying to project out a return to 2% inflation within 12 months or so. And every time you see the updated estimates from the Fed, they're always just changing the goalpost, but always having to come back to 2% just a year later. And we would expect that it might be a bit more difficult. It's a bit of a blunt tool that the Fed has to try and bring down demand around the world and slow down the economy and have that be the reason why inflation comes down. So we do expect inflation to decelerate, but that might mean that inflation is still at 7 to 8% this quarter, might be between 6 and 7% in the first quarter next year, and then really still 4 or 5% at the midpoint of next year. So it may take a bit longer or a bit more effort than they'd like to get back to that 2% number that they want things to be at.
Well, 4 to 5% is still a significant decrease from current levels, as you've mentioned. What would cause this deceleration?
We think it would just be really a focus on them continuing to try to bring down demand. We actually think the first half of next year is going to be when you really see more of a slowdown in economic activity. Right now, the consumer has stayed resilient enough, spending on services and drawing down on their personal savings. And we think that will continue to be somewhat okay through the holidays. But by the first half of next year, we think things might be pretty difficult in terms of generating economic growth. And if you look at history, that tends to be a driver of bringing down inflation, just if you've got very little growth to speak of around the world.
I'm going to share with you a viewpoint that's been brought up to me, and I'd like you to comment on this. There is a view that there is nothing the Federal Reserve can do that can bring down inflation. There's two reasons for this. One, if you take a look at the percentage increase of rates that's going up, it's rather insignificant compared to historical levels. So even though they are raising rates at a very fast pace, the rate of change is high, the absolute level is still very low. Compare that to the Volcker days when Volcker raised interest rates to double digits to combat double-digit inflation. So we're nowhere near 8% interest rates, which is, some would argue, is needed to bring down 8% inflation. That's number one. Number two, the Federal Reserve can control monetary policy, but they can't control directly supply chain issues that are exacerbating inflation. For example, in the U.S., there's a diesel shortage that's going on currently. Some would argue that fuel shortages, energy crises could continue this inflationary pressure on the ordinary citizen. And so that's not something the Fed can control. That's just something that the economy needs to work out over time, or perhaps we need to produce more oil, whatever the case may be, not within the Fed's control. How would you respond to those 2 points?
I think those points are fair. When you look at, especially in the energy market, right now, if other commodities, there's been a significant fall off in price. If you're looking at more industrial metals, But in terms of oil and natural gas, especially in oil, that's stayed up probably a little bit more than the Fed and the government really would expect based off how much they've tried to raise interest rates. And to your point, going up by nearly 400 basis points in a year, that's pretty sizable move. But we saw larger tightenings in policy during the Volcker era in the 1970s and early 1980s. But it is a bit of a shock to the system. So you would expect oil prices to come down maybe more even than they already have. And yet, because there's not enough new supply being generated, and you might get some additional stimulus or some additional demand coming either from China next year if they started to open up their economy a bit more, if the U.S. stopped trying to release reserves from their strategic reserves, and then there's just a little bit more demand every year for fossil fuels. All of those factors could lead to oil prices staying up a little bit longer, you think, and that would be an issue for the Fed that's really trying to get back down to 2%. But to your point, not entirely in their control and may lead to this being more of a longer, drawn-out issue.
Well, Jerome Powell is not Paul Volcker. How high do you think the Fed funds rate could go before they eventually pivot?
Well, right now, what's expected is that they'll be able to get the Fed rate up to 5%. First, let's see if we can get there without something breaking in the financial system. You saw the issues that were happening in the UK with their pensions. They were able to somewhat resolve that, even though the UK rates are still quite high. But if they can get up to 5% without anything significantly breaking, they definitely could try to get there. We saw some reports that they could try to get up to 5.5% or 6% on the Fed funds rate, but we wouldn't expect that at this time. And that would also create issues where the amount of interest expense that the U.S. government would have to pay on that, as you have to start to issue new debt to replace the debt that's maturing, that interest expense is going to increase substantially and would be a problem in terms of a budget deficit issue. So that's not really a long-term plan for them.
And do you expect Treasury yields to continue to go up as well?
We think as much as yields have gone up throughout the past year, most of that damage for bond investors has probably already been done. Right now, you've got short-term Treasury yields at about 4.5%. On the longer end of the curve, it's more around 4%. You could see a rise where, let's say they get the Fed funds rate up near 5%. That means the 2-year yield will probably go up to about 5% as well. And then you could see the 10-year and 30-year yield rise from 4 up to about 4.5 in that scenario, while still maintaining that inversion versus the short-term rates. So there might be a little bit further to go, but we think most of this rise has already happened.
Okay, just want to pull up a few charts and comment on these charts here. The first one showing the 10-year yield. Now, as you can see in this chart, the 10-year yield started moving around mid-2021 or late 2020. This is in contrast to the short end of the curve, the 2-year yield, which only started moving much later. So if you go to the 2-year yield now, you'll see that the 2-year yield only started moving up around 2022. And, before we comment on the yield curve, why do you think that the short end of the curve moved a lot later than the long end of the curve, and more dramatically at that when it did start moving?
The long end of the curve tends to move more with what the market sets the rate at, what they expect inflation expectations and real GDP growth to be. And so the fact that you started to see the 10-year rate move up in late 2020, we would view that as a response to all of the fiscal and monetary stimulus that was being put out into the system. And maybe a response, especially after the vaccine announcement in November of that year, realizing that inflation was going to accelerate, growth was going to accelerate. And so that would be why the market moved first. On the opposite side, the short end of the yield curve, say 2 years or less, tends to move a lot more with Federal Reserve policy. So because the Fed was still providing QE all the way through 2021 and into the beginning of 2022, it took a while for the 2-year rate to start to move up because you had no telegraph by the Fed that they were going to start increasing rates yet. But once you got within about 6 months of that ending of QE in March 2022, I think that's when you started to see the 2-year start to drift up.
It's interesting because the 10-year, again, as we pointed out, started drifting up around late 2020. Back then, there was still a bull rally in the stock markets and all risk assets, actually, including cryptocurrencies. It wasn't until the 2 years started drifting up, or moving up dramatically. It wasn't even a drift. It was a spike up like a rocket ship around late 2021 that the equities markets and the cryptocurrency markets, basically risk assets, started falling. And we've been in the bear market ever since. Generally speaking, Chance, what is the relationship between yields and the stock market?
It's interesting now because so many investors, they have an Excel spreadsheet for their models. They were taught this in business school, like, oh, you got to adjust your discount rate.
Yeah.
And if your short-term interest rates, the risk-free rate goes up, that's going to naturally lower the future cash flows of these businesses you're thinking about investing in. And it almost seems like it's been a very expected response where valuations have come back down as the Fed began to raise rates and say they were going to raise rates further. So I'd say it's a pretty expected response, and that really hurt the businesses that don't generate much in the way of free cash flow today. And you're really banking on this great future outcome. Those are the ones that have really been hit the most by rates moving higher.
You don't really adjust your discounted cash flow every single day, though. Well, maybe you do, but I mean, you factor in your assumption for your 2-year yield or your 5-year, whatever the case may be that your input that you're using. But you know, it seems to me that valuations were continuously adjusted downwards over the last 3 quarters or so, which is reflected in the stock prices, right? You would think that people would expect rates to go up and then adjust it once, and that would be the end of the correction. But that wasn't the case, Chance.
Yeah, I think there's a couple of points there. So first, I don't think investors were prepared for how much rates have increased. And just looking at the last 12, 13 years, you never saw them really being able to get the 10-year yield above 2 or 3%. And they certainly couldn't get the Fed funds rate above that. So I think getting to where you're at 4 or 4.5, potentially 5% has really shocked investors and had to recalibrate. And from our perspective, free cash flow generation has really become, in our mind, the top predictor of how these valuations are moving for specific stocks. Even if you say a company's got a lot of EBITDA or something, some generic metric like that, if their free cash flow is not there, then you're going to see that valuation come down.
Chance, let's take a look at how companies have historically performed in the wake of rising interest rates. One of the themes of this year and beyond is the end of zero interest rates. You'll recall that we've had near zero interest rates for a very long time, Chance. In this environment, when we have rising rates and rising fast, which sectors tend to outperform, which sectors tend to underperform the most?
Well, when you have rising rates like this, it tends to be, as we're experiencing, a more inflationary environment. So that typically leads to good results for energy, certain materials businesses, although a lot of those materials businesses have rolled over because commodity prices outside of energy have been coming down for the past 6 months. You could also, in a normal yield curve environment, it would be a good environment for financials. The problem is you've got an inverted yield curve, so it creates a difficult dynamic for paying short-term deposits and then lending long for banks or for other insurance businesses. So it hasn't maybe been quite as beneficial for banks as maybe they would have liked if you would have told them that rates were going to start going up this year.
That's right.
But where you see on the opposite side is, especially in recent months, there's been a lot of pain for utilities and REITs, those two sectors. And that's just because of rising rates. Those are businesses that cap rates for commercial property, and then utilities is a bit of a bond surrogate or proxy that you might want to own instead of bonds. But now that you can get a 4.5% 1-year treasury yield, do you really want to own a utility that only pays a 3% dividend? So those are conversations that investors have not had for a long time, but now can start making those comparisons and may decide that they want to take some risk off the table and move things more towards short-term treasuries.
Looking at the chart of the yield curve, in the past, whenever the yield curve reaches zero, that tends to lead a recession by 6 to 8 months. Now, the yield curve reached zero back in July for the second time this year, and it's been in negative territory ever since July. So that's 5 months already, almost 5 months of negative territory for the yield curve. Are we in a recession? It's undecided because the National Bureau of Economic Research, which is the organization that designates recessions, they haven't come out and officially assigned this period as a recession yet. So there's been some political back and forth as to whether or not this actually is a recession. How would you characterize this economic environment? If the yield curve is any indicator at all, we should be in a recession very soon, right?
Sure. So while I understand that the first 2 quarters of this year was more technical reasons why you had real GDP growth be negative. First, it was due to net exports, and then in the second quarter, it was due to the way inventories were being adjusted from quarter to quarter. But if you end up with 2 negative quarters in a row, in our mind, that would be a recession, even if it was just a mild one at the start of this year. What we think the yield curve, the 2-year and 10-year inversion there, and then real recently, the inversion between the 3-month rate and the 10-year rate, what that's forecasting for us is the recession, whether you want to tie it all together or say it's a second recession in this period, coming in the first half of next year. We think that's going to be a difficult environment. And the 2-year, 10-year inversion tends to happen a little bit earlier than the 3-month, 10-year. But that inversion between the 3-month Treasury and the 10-year Treasury rate, I believe it's 8 for 8 in predicting recessions going back about half a century. And so the fact that we're sitting in that environment right now, and that inversion may even get steeper as short-term rates continue to rise, would portend a difficult environment going into next year.
All right, so let's take a look at how this affects equity valuations and prices in particular. You have this table showing historical PEs, forward PEs during past recessions. So low PE in recession is 11 to 13 times. Now, just taking a look at 2007 to 2009, the 2008 recession, for example, the start of the recession was 15, and it contracted to 10. So typically multiples contract by, according to your table, 2.6 to 5, 12 in the case of the dot-com bubble. What are we looking at currently, Chance? What are we expecting for this recessionary cycle?
Well, what we looked at, or what was most interesting to us in that chart, which came from Rosenberg Research, was the end point. So in those major recessions, when you really had a capitulation among investors and a drawn out bear market and recession, you typically ended up between 11 and 13 times forward earnings. And so for us right now, we're at 16 and a half times earnings today. So it tells you, I mean, for the long term, if you looked at a 30-year history of forward price to earnings ratios, 16 to 17 times is average. And you typically don't bottom in the market at an average valuation. You typically have to go through the average to a below average level, the same way that you peaked at an above average level. So we would be looking for more panic in terms of selling by investors that gets us to a valuation closer to those levels. And the other piece of this is earnings expectations to us are still too high for next year. It's interesting. Everyone responded very positively to Apple's earnings report last week, and we still own Apple for clients. We think it's a fantastic business, but we think expectations are still a bit too high for next year, considering that earnings growth is expected for a business that still sells tech hardware and has its services growth slowing down, being only 5% in the most recently reported quarter.
So if you think valuations, in particular the PE ratio, is going to contract even more to underneath or below the average level, which is what we're currently at, what does that translate to prices? How far do we have left to go for the S&P 500, for example, to correct before we hit rock bottom valuations?
Well, we're always evaluating it kind of in real time. So for most of this year, our starting point is we just need to see the S&P 500 start drifting down towards about 3,400 at the very least. And then you can start coming up with combinations of a PE ratio and an earnings number for the S&P 500. They could get you into the low 3,000s. We see more apocalyptic type scenarios that are put out, have you falling into the 2,000s. It's certainly possible, considering that we've had 50% declines in the market several times in the last 50 years, and that would take you from 4,800 down to the mid 2000s. I don't know that we go that far, but just looking at this directionally, if we're still at the high 3,000s in the S&P 500 today, that just tells us that we don't think this is done. And the fact that earnings expectations are still too high for next year tells us that people haven't really factored in the recessionary environment that we may still be dealing with in 2023.
Okay. If you take a look at 2008, for example, things started collapsing around fall 2008 and it troughed around, I believe, the spring of 2009. That's about a roughly 6 to 7 month, I'm ballparking, roughly a half a year period of a bear market. We've already seen that chance. So what are the chances that we're going to get a rebound from here? Is basically what investors are wondering. Because if you just take a look at historical precedents, again, 2008, for example, we've already kind of exceeded the usual length of a bear market before things trough, have we not?
Actually, I don't think we have for this sort of a drawn out bear market. In that example, you cite the high, like we just had the high made basically New Year's Day of this year. So we're about 9 or 10 months into it. The high in that great financial crisis was October of 2007. So that was an 18-month bear market essentially before you bottomed. We're only halfway into that. Same thing in the dot-com bubble. We peaked in March of 2000, didn't hit a final low until March of 2003. It took 3 years. And then the previous one everyone cites was 1973 and 74, and that was a nearly 2-year bear market. So it could go well into next year. And it's something that we're constantly monitoring, because if you do see a full capitulation where now investors panic too far, we want to be sure that we're a step ahead and we're ready to take advantage of that. But as of now, we think the environment is still a bit too complacent among investors.
Okay. Right. Well, so looking ahead then, asset allocation. If you're bearish in the markets and you think that there's probably more downside ahead before things rebound, how are you positioning your portfolio, Chance?
Sure. So in our income strategies, we have a large allocation to short-term treasuries that are generating a 4 or 4.5% yield. We think that's a safe spot to be, just because so many areas of risk assets we think still have downside ahead. Given what's happening right now in the oil market and our high income strategy, we also still have some exposure to energy, not as much as we did at the beginning of the year, but we still like owning some pipeline businesses, and I've added a couple small positions in some other energy companies like Devon Energy or Pioneer Natural Resources, just to have exposure in case you see the oil price really rise in the quarters ahead. It's still kind of on the fence as to how the oil price is going to move here in the months to come. And then last area there would just be a focus on some high quality preferred stocks that can generate some good yield. And then in the stock market side, for our equity portfolios for clients, we're positioned very conservatively, probably as conservative as we've been in over a decade, where we've got, again, about half of the portfolio in short-term treasuries, just generating some yield, and the remainder in an assortment of very high-quality businesses that have consistent cash flow, high profit margins, and great balance sheets. And those would be businesses like Visa or MasterCard, O'Reilly Auto, areas that we think are going to be able to get through this period okay, and that we don't think we're overpaying for.
Okay. What about the tech side? Now, back in 2020, when we had a major correction, tech stocks actually did very well, rebounded quite significantly thereafter. Well, of course, the entire market's rebounded, but tech stocks in particular, you would think that people would stop spending money during a pandemic, but in fact, they went. They dove headfirst into online retailers, things like Amazon, skyrocketed. What about this time around? Do you think subscription services, not like Amazon, but things like Netflix, things like Apple Music, perhaps even video game companies that you have to pay a monthly subscription to, do you think those will falter during an economic downturn?
It's a new environment for them, and it'll be interesting to see what consumers decide to keep versus what they decide to get rid of. The video game example, we don't own any video game companies, but it's interesting. They've all switched to this sort of free, but then pay for additional services type model, which has been very lucrative for them for the last decade. But what it means is they actually are less resilient in a recession than they have been in past recessions, because users are just not going to pay as much for those extra services as they might have in the past. And all you had to do is just buy the video game, and then you had hours and hours of entertainment to go off of. So it's going to be interesting to see how that plays out. Where we're focused is more on enterprise software, and you are seeing a deceleration in their customers trying to cut back a bit on how much they're spending for whether it's cloud services or specific types of software they need for their companies.
It's interesting that we have this dichotomy. I read that during a recession, and correct me if I'm wrong, Chance, if your research suggests otherwise, but I read that during a recession, typically people flock to entertainment because I guess you're depressed and you have nothing to do, and so you find cheap forms of entertainment, not like, vacations and cruise ships, but you go to the movies more, where you perhaps watch shows a bit more, or whatever forms of entertainment you're interested in. Is that a sector that perhaps, even although cyclical as it may be, is that a sector that you think could perhaps do well?
It could hold up better than expected. The point that you make that it's still cyclical, probably be our main focus. You might still have a bit more of a fall off in earnings over a difficult economic environment before it rallies back. I think where you see that more in terms of like affordable luxuries is what you hear that said more times. Anheuser-Busch InBev just reported and showed that people may not want to buy luxury goods that cost thousands of dollars, but they may still buy their premium beer that they want to buy because you're talking very minimal purchase. Similarly, that applies somewhat to the beauty market. McDonald's has talked about that they're actually seeing more traffic because you have people downshifting, but still going to a fast food restaurant like that, whereas maybe they're not going out to eat, sit-down restaurants as much. So there's a bit of an interplay there, but you have to focus more on the low end of the market that's going to hold up better.
Morgan Stanley recently reported that Rolex prices are expected to drop even further. So I don't know if that's an indication of anything, but perhaps that's just a company-specific oversupply. But to your point about people not spending as much money on high-end luxuries, that's probably one indicator. Finally, how do you feel about gold and precious metals, Chance?
Long term, I think we have an interest in always having some exposure to gold and precious metals, especially in our high income strategy that's always trying to grow a little bit faster than inflation through a full cycle. And right now, I think in the short term, this is a difficult environment just because you have the US dollar strengthening and you have real interest rates. So take the 10-year treasury rate against what inflation expectations are for 10 years from now. So not the 8% CPI number you see, but you can actually calculate, and they take surveys to see what is expected for inflation a decade ahead. Right now, real interest rates are about as high as they've been in a number of years. That's a tough environment for gold and precious metals to do well. But if you get to a point where a recession really hits home and you see more of a sell-off in the stock market, we would expect long-term treasury rates to eventually come back down like they always do when a recession really takes hold. And that would be an environment where we would expect gold and precious metals to start performing well again.
All right, Chance. Excellent thoughts. Thank you very much for joining us today. And I'll look forward to speaking with you next time.
Thanks a lot, David.
Thank you for watching Kitco News. I'm David Lin.